because the GDP report showed just a 0.5% annual growth rate, I wanted to take some time to dig into the details of that report because there are some important reasons to believe that things are actually better based on significant underlying strength than the headline number suggests. I think the stock market by and large agrees with that assessment, interestingly, despite the two-day sell-off following Thursday's GDP report, in as much as the S&P 500 is still off less than 4% from last year's record all-time high. I guess the point I'm making here is, yes, we've seen 2 consecutive down days in the stock market following that GDP report. Today, Friday, midday, the market appears to be turning around just a little bit. But I think, again, importantly, the main takeaway is that despite this seemingly bad economic news, the stock market is not interpreting it as very bad at all and is holding near record all-time highs. That said, let's go through the numbers. In this chart, you're looking at actual and the latest forecasted GDP growth looking out through the next 3 quarters through the end of this year. A couple of observations on this chart. First of all, you can see, and I'm going to use my pointer here, fourth quarter GDP growth of 1.4%, first quarter GDP growth of just 0.5%. Now, interestingly, we've seen this seasonality now for a number of years, and economists aren't exactly sure why we're getting that seasonality, but my point is that it looks like a pretty typical pattern, notwithstanding the weakness here of 0.5%. Last year, for example, in the second quarter, we had this snapback to a gangbusters 3.9% GDP growth. So that's point number one. Point number two in this chart is that, as you can see in the red bars, this is the latest consensus forecast from the 70 economists surveyed by the Wall Street Journal every month. And again, economists are taking the first quarter with a grain of salt, saying, yes, there are some particular reasons why we had this weakness, but notwithstanding that, we all believe that we're going to see considerable strength for the next 3 quarters in a row, averaging 2.4% year-over-year annualized rate. This next chart shows how the GDP breaks down among its 4 constituent pieces, C plus I plus G plus net exports. And the key takeaway here is that personal consumption expenditures, as we all know, drive the U.S. economy. So in this particular case, you're going to hear lots of commentary on the weakness in gross private domestic investment and the weakness in net exports, which I'm going to get to in a second. In fact, that's going to be the main focus of my presentation today. But the point here is that we all need to focus on whether or not there is ongoing strength, underlying strength in personal consumption expenditures, because again, the U.S. economy is driven by personal spending, consumer spending. So here are those same 4 cylinders of the U.S. GDP: personal consumption expenditures, investment, government spending, and net exports. And you can see here that of the 0.5% reported, then consumption actually contributed 1.3%, which is this trend up here. And that's the key takeaway that I wanted to leave. The point is that this trend remains solid, in the solid recovery mode. And in a second I'm going to get to what's driving that. But my point is that, yes, it is cyclical quarter to quarter, but I have no doubt that we're going to see an upswing in this in the quarters ahead. The second category here is gross private domestic investment. And here, interestingly, we've seen a 3-quarter inventory correction. To the extent that inventories grow more slowly or contract, you have a takeaway from GDP growth. That's occurred now for 3 quarters in a row. There is no question in my mind that in some quarter immediately ahead, we're going to see a dramatic rebound in the contribution from inventory. Now, more importantly, though, in this category, you've heard a lot of talking heads in the media talking about the fact that companies aren't investing in their businesses. It's patently false, and I'm going to spend some time getting into those details in just a second. There's a lot of underlying strength coming from investment that is not being recognized. And the final point here is in this 4th cylinder, net exports actually consistently are a drag on the U.S. economy because this country imports more than we export. So it is no surprise that we had a 0.3% takeaway from net exports, and actually that's better than one might expect for a number of reasons, which I'll also get into in just a second. Okay, so let's look at personal consumption expenditures. The main driver, the driver of personal consumption expenditures is consumer income. And this is the report that was released this morning, Friday, April 29th. And you can see here that personal income, which is composed of 5 separate categories, the majority being employee compensation, but including significant contributions from small business income, rental income, interest and dividends, and government transfer payments, has been growing at a very robust 4.2% year over year. That's an interesting observation because I don't think you'd conclude that from listening to people in the media. Personal income, the key driver of personal consumption expenditures, has been growing at a very healthy rate, which continued through March, the data released today. Take away personal income taxes from consumer income and you get disposable personal income, and this is the after-tax driver, of course, of personal spending. And again, disposable personal income up 4% year over year. That was released this morning, compared to 4.4% in the last boom year preceding the last recession. I think that's a very favorable comparison. On an after-inflation basis, the story gets even more interesting, which I'll get to in a second. But disposable personal income, of course, is the driver of personal outlays. The black line in this chart is that 69% of GDP that you so often hear referred to. That comes right out of the GDP account. Now, interestingly, Americans are banking more of their monthly income than they have been for a long time. So personal outlays growing 3.5% versus disposable personal income growing at 4% has resulted in rising savings rate. The savings rate at 5.4% reported this morning is actually very impressive by recent historical standards. And yes, you can complain that, well, Americans aren't spending all of their monthly income. Is that a bad thing? No. First of all, I think it's going to be a temporary thing. And secondly, no, to the extent that Americans are rebuilding their household savings is nothing but good news with respect to their propensity to spend money in future periods. All right, now let's go and look at these same figures on an after-inflation basis, an inflation-adjusted basis. And as I said, this is where the story gets pretty darned interesting because real disposable personal income most recently reported growing 3.1% year over year compared to the 5-year compound annual growth rate in this very rapid expansion of just 2.8%. Wow. This is not being commented upon in the media. In other words, because we've moved into a very low inflation environment, as a matter of fact, Americans' purchasing power has been growing faster than it had during the fast economic expansion between the last 2 recessions. And finally, let's adjust that number per capita, and you realize that real disposable income per capita has gone out to record all-time highs here. Income stagnation? I don't think so. And this is a fiction being foisted upon the American public by the candidates running for office. That's another reason for my focusing on the statistic in particular, because the candidate in an election season, it behooves candidates to tell us how lousy things have been, and if you elect me, I'll make these changes. Well, in fact, that is a tall tale. That's a fantasy. There is no income stagnation in the United States in the last couple of years. Yes, there was, you can see that, but that's an old story. The final point I'll make on the health of U.S. consumers and the health of U.S. spending growth, again, the preeminent driver of total economic output is retail sales. Every month, like clockwork, we've heard the CEOs of major retailers like Macy's, Nordstrom, Kohl's, and Gap, and others complaining about soft comp store sales. Well, guess what? They're in a dying industry, a dying retail format, I should say. Now, most recently in March, we saw a little downtick in retail sales, but as a matter of fact, on a year-over-year basis, retail sales are on fire. On fire. I'll say it again. Retail sales are on fire. And the figures here that you see just belie this story of weak consumer spending, up 3.4% year over year compared to, again, that boom year preceding the last bust. Now the answer to this conundrum or enigma, to the extent there is an enigma, and I think there is, I think there's a lot of misunderstanding in this area, is that these hard luck stories from the major brick and mortar retailers are down here in retail department store sales, which is a dying retail format. Whereas look here in non-store retailers, also known as Amazon and the other internet retailers, and you're seeing this very robust 6.3% year over year, or food services and drinking, up 5.6% year over year. Car sales have been on fire, and so forth. So again, the headline number on retail sales has been very strong indeed, notwithstanding all of the talk of weakness from the brick and mortar retails. Now, let's shift gears and talk about gross private domestic investment. Again, my point being to focus on this three consecutive quarters of weakness in this gross private domestic investment account. And I'm doing this principally to dispel some of the misinformation I think that's being propagated out there. First of all, here's the number, gross private domestic investment rolling over for 3 consecutive quarters. And see, this is why people are talking all about, even Carl Icahn on TV this morning, and Warren Buffett and other people say, oh, companies aren't investing in their businesses. Nonsense. It's absolutely not true. The point here is that total investment plunged during the recession, as you can see, hasn't recovered as fast as GDP. In other words, hasn't risen to the level of GDP growth, and has lately rolled over. So that's the complaint. Now, let's look behind that aggregate figure. It breaks down into 4 individual pieces aside from the inventory. Inventory is not included in this, but the main gross private investment categories are illustrated in this chart. And guess what we see? The weakness is down here in non-residential structures and residential fixed investment, although you can see that the rate of gain here in residential construction actually is faster than GDP growth. So yeah, it's taken a long time for residential home construction to recover, but its rate of growth at present is actually very impressive compared to overall GDP. But back to the big story here. Non-residential weakness in non-residential structures and weakness in non-residential equipment spending. Well, guess what? Look at the footnotes in this chart. Recent weakness in transportation and other equipment, which includes mining and oil field machinery. And non-residential structures, guess what? Weakness is entirely due to the collapse in mining exploration shafts and wells. No surprise. The collapse in the energy industry is accounting for this purported weakness across the board in corporate CapEx. So here, let's look at the breakdown back here. Let's look at the breakdown specifically of non-residential structure investment weakness. Lo and behold, every category within that broad category has been rising, and in fact rose in the first quarter, but for the absolute collapse in investment in mining, exploration, shafts, and wells. Wow, an interesting sub-story. And finally, and the bottom line with respect to investment, private capital investment, is the breakdown of corporate CapEx. And this is a key story because I don't know how many times I've heard people in the media on CNBC and elsewhere talking about the weakness in corporate capital expenditures. And the importance of that, of course, is to the extent companies aren't investing in their businesses, then we can't get productivity increases, which is a key driver of GDP growth. Well, the narrative is entirely false. And here's the evidence. Corporate CapEx in all of these categories has been growing faster than GDP. All of these categories has been growing faster than GDP, and we're actually at levels higher than GDP from the start of this chart, except for information processing and equipment. And usually that's because of deflation. You get more for your money continuously in that category over time. Okay, so again, the collapse in energy and oil field investment has temporarily put a big hit on gross private domestic investment, but that I think will definitely prove to be temporary. And the good news here is that look at this explosion in investment in manufacturing structures and in software and research and development and in industrial equipment. It's so impressive and so contrary to the widely accepted narrative out there. Now the last point I want to make, again going back to the four cylinders of GDP is net exports, because here's also a very interesting story. Typically, well, back up here, the net export contribution to GDP is illustrated in this chart. The United States exports goods and we import goods, and it's the difference between the two that either contributes to or takes away from GDP, which is this red data series right here. So the immediate conclusion, the obvious conclusion is net exports are always a net takeaway from U.S. GDP. So the fact that we are at minus 0.3% in the first quarter is entirely consistent with the long-term history of this category. But here's what's encouraging on the net export front. With the strong dollar, you see, U.S. goods exports have gotten hurt. Services not. But goods exports have gotten hurt with U.S. strong dollar. But guess what? The flip side of strong dollar has been that dollar value of imports also has shrunk. And that is entirely due to the dollar value of petroleum imports. To the extent that we have to import less from Saudi Arabia, we produce more here at home, then petroleum imports as a percent of GDP have declined from the max here at 3.7% of GDP in 2008, a full three percentage points decline to 0.7% of GDP most recently, petroleum imports as a percent of GDP. Another way of saying this is that the net exports category would be 3 percentage points wider were it not for the explosion in domestic U.S. shale oil production. All right, those are the points I wanted to make today, and I think those are very important observations to keep in mind when you're hearing about the weakness in the U.S. economy post this first quarter GDP release. Thank you very much.